Hello, Warriors. The official start of the fall trading season begins this week. We had the equinox, I believe it was yesterday. So, looking for the markets to breathe a little bit this week. Gordon Stanmore, welcome to F.A.C.E. Your first time here? How'd you find us? How you doing, Sinatra? Blake, let's have a great week. James, Alexander, Brand with the testimonial. Hi, Ryan. Patrick. Patrick's back in here. Loyal. Hugo. There's KMan and Laura. Good morning, Laura. YouTube. Okay. Thanks. All right, guys, let's go to work. So, a little bit of, I'm going to start off with Ryan. Good morning over there in the UK, Ryan. How are you?
Good morning, mate. I'm very well. How are you?
Okay, bro. So, are you quite, first of all, what's the plan? I know you were long euro against 110. I kind of think we're going to revisit it down here. What do you think?
It's possible.
Yeah.
We can't get through 110.70. That's my level right here and now.
Okay.
Yeah, we could go to 110. I think we're in for a bit of consolidation, swinging
Yeah.
between the data points and whatnot. So 110 is possible. I may have a look down there if we get there, depending on how we get there. I don't think we're done with 112, but you know, I'm not I'm not expecting a break there and then a quick run up
Yeah.
to 114 or something unless it's big news behind it.
Okay. Well, there's plenty of big news out there, and also, you know, euro pound finally broke down, like you said, when we tried the 84s and um, accelerating to the downside.
Yeah, if you can call if you can call 30 pips, 20 pips an acceleration on the day, but yeah, this one's
From a
gone without
wagon,
me. Well,
from a well, if you were in a red wagon being pulled by your dad, and
yeah,
he
if you're on
starts
a
to
cliff edge, you've
run,
got to go slowly.
yeah,
But,
and he starts to run, you feel the acceleration of the euro
yeah,
pound trade.
G-force,
It's the same
G-force.
thing.
I feel
Yeah.
my cheeks around my ears.
All right,
Um,
skip it. The trend's down. I don't
yeah,
see any sign of a turn. I don't have any divergences. Maybe short term there is. So it looks kind of entrenched right here.
yeah,
Um,
we got to look a bit wider for the levels now.
yeah,
The next one on my chart is around 83.40 ish, 35.40. But really, you got to be looking at a daily or weekly chart minimum to see the levels here.
okay.
We've probably got about three or four decent levels down to the big one, which is at 82.
There it is. Okay. I don't see any reason why we can't try 82. So,
No,
anyway, we'll see day at a time. Commodity currencies, a little stiffer. Aussie threatening a breakout on my work. I thought it would pull back. I took some off Friday, and I'm not just not keen on adding up here, even though it's a breakout. I think I'd wait for a close or two
it's
to
looking
firm up.
solid on that 80, that 68 even
Yeah,
level. And if you flick
yeah,
it back to the weekly, we're opening um, we're opening the week above that level as well. It's a nice at the moment, albeit a Monday. It's a nice looking candle on the weekly.
weekly. Oh yeah, and you know what? I think that the commodity currencies are going to have larger moves than the other ones. Um, so here we go. The only reason I'm a little hesitant is I'm not sure uh, about Canada if we can't just pull back and then make another run. And I really don't want to short any dollars until I still think there's a shot for 102 here. Um, let me bring K-Man in. Good morning, Kay.
Morning, Dale. Morning, everybody.
So, US dollar yen, do you think that the move that we, have been in since the low has any staying power, or this might be it?
Well, I'm just in very, very small tryouts to see if those 143s are holding for a push higher. But yeah, I thought it would be a little better bid, but we're stalling around that mid to mid 44s, which is also a bit of a resistance. So looks rangy to me to start the week. It's going to be mostly dollar dependent until the end of the week, I think, where we have the LDP elections. There's a bit of geopolitics in there as well, because apparently some of the Japanese aircraft have fired flares at a Russian aircraft or so. So yeah, I don't know.
Well, everyone's firing everything.
It's
There's a lot, a lot,
geopolitics.
lot of triggers being pulled.
Yeah, geopolitics are playing a bit of a nasty role in it, perhaps to start the week.
Maybe,
And,
maybe they don't really come home to roost until next year,
mm,
or after the election.
yeah.
But I heard a guy who's pretty good. I interviewed him once, and Jem Carson. I think Blake interviewed him. I was out that day, and he's a guy who looks at skew, that kind of stuff. And he actually said, dangerous to short the market, but next year he thinks all these things, both economic and geo, are going to be playing a bigger role in the market. Actually talked about a lost decade, like some people are talking about once this ends. A good thing we have Peter Goodburn on because, he's going to show it doesn't end after the election. So, keep an open mind. Uh, uh, the yen, I still think it has more left in it, probably because, well, definitely because of my bias in what's happening in yields. I
Mhm.
don't think they're doing much today, but I'm actually looking for, a move to here, 390. I don't know what's going to set it off, but
It could be the elections because they're both going to spend more. So
okay,
it could be the elections that those yields are pulling back up at least for a while, and then we will see whether the spending is helping the economy or not, and that will be the ultimate decider, in my opinion, whether economies hold up or not, and then. We know if you go back to the end, we know that the interest rate differentials are tightening because the Bank of Japan is still in its hiking cycle, and the Fed has started to come down.
yeah.
So will the ECB. If you look at the PMI data this morning, they were absolutely awful in Euroland. I so there's still a fairly good reason to somewhere find tops in dollar yen or in any yen crosses for now. But I'm still wondering the about the viability of everything. I can imagine if the U.S. economy would hold up and we go into soft landing, you get a little bit more. You get a little bit more. Positive curve.
Yeah.
I'd say perhaps dollar yen is after all going to hold somewhere, call it roughly 38.40 or so. I know a lot of
Okay.
people are looking for it to go back to 125, but I'm not overly convinced yet.
Well, if it ever takes out 140, I mean, I've showed this weekly. Maybe it was even the monthly. How big this area is. Here you go. You got this. You got this. You know, and on the weekly, it's even clearer.
Hmm. Well,
So it's a big area.
it is, but a lot will depend on how I think the U.S. economy will fare.
Okay.
That's what I
Yeah.
think. Yeah.
All right. Well, there's two drives here, right? Here's one. Here's your
Mhm.
first divergence trying to come out of here. There could be a third.
Mhm.
Anyway,
Yep.
uh,
Metals.
Yeah, what first day I've seen silver down hard and gold up in a long time, and I thought the gold silver ratio was peaking. I don't know now. Maybe this is
Well,
a flag and this is just consolidating and it's going to blow off again.
we're always coming back to the same thing about silver versus gold. There is the dollar correlation, obviously, but you also have the economic and the industrial correlation. Imagine that PMIs are starting to show weaker data.
Okay, yeah.
Silver should underperform gold, right? Because of its usage. I mean, just from a market perspective.
Yeah, recession would not help silver.
I'm sorry?
A recession is not bullish
Wouldn't.
silver.
In theory, it wouldn't, but it will go probably up a little bit in correlation with the lower dollar price. But then I think the gold silver ratio should actually be higher than, especially the
Then
geopolitics are not done yet. So
yeah, I mean
gold still has this attraction to me. And I'm not only looking at yields, I'm looking at everything that's going on. I mean, it's not the global situation is not improving right now, and there's very little reason for gold to come off in current context.
yeah, it'll come off on a risk off event again.
It could.
I'm
You know
curious.
what?
I haven't asked this. What's a DSI in gold right now, guys? Is it in the 90s?
No, I don't.
I'll look right now. And while you guys are talking, I'll find out for you.
All right.
It's in the newsroom in the ForexAnalytix chat room.
It's at
So,
84. 84 on Friday.
yep, he is correct.
Okay. All right. Thank you very much.
But
All right. Well, I took this trade, a few weeks ago because I had an upset stomach. Nat gas is acting pretty good.
well,
That was my trading signal.
yeah,
I ate my own cooking and had some abdominal cramps. I go, oh boy, I better get long nat gas.
it has
And
natural in the name, Dale. You gotta respect it.
it is. All right. So anyway, TMI. Um, I have to think though that the bonds, they're going to get cheaper, TLT, but that they're probably setting up. I don't know if this completes the whole bear market rally. So there should be a good bond buy setting up here in the next few weeks on this bounce in yields. I don't think it's any more than a bounce to, 394%. Here you go. Here's 390. And you know what? Here's a two drive. Look at these charts. They're tied at the hip now. So, one might get a little ahead of each other, but this says a rally and then a third drive. It might. And then I just want to get to Blake about risk. And I just have one, everyone's trying to come up with the numbers for when this wave will end. I've heard anything from 58.5 to 63. That's a general range for this. And I thought instead of trying to predict the price, which just let it, uh, do its thing and give you some type of drive formation within three. So I've seen this happen before. Drive one, drive two, and on the third drive, I'll be looking for a fractal of this. Okay. So, it could take, several more weeks, could take a month or so for us to get some type of three drive formation that'll show up better on the 4 hour. But instead of trying to, drive myself crazy and say, well, I'll sell it some at 58.50, some at 61, and then you go, well, should have waited for the high end of the range at 63. Just let the charts tell you.
Well,
right?
yeah,
You'll
I
get,
mean,
you know what I mean? Why are we driving ourselves crazy? Just let the price action tell you. You'll see distribution. You'll see divergences. We'll see it. Don't worry about it. Don't worry about
well,
what the price is. We'll
you're
see it.
right. You're right, Dale, and I'll tell you that the week ahead video, I was just like, look, I actually think we're going to fail up here. I know everybody's looking for higher prices right now. I actually think that this market's going to fail up here, but I'm not going to be shorting risk until you get back below the breakout point. So that means back below basically 56.20, and then I'll be looking for short because I for a short out because I think it's a false breakout in the event it happens. But there's no sense in trying to sell it up here because between here and as you're pointing out, and I'll show you what the way I'm looking at it is it is a wedge pattern, right? It is a bullish pattern. So there's, like you said, there's no sense in trying to drive yourself crazy and
Yeah,
trying to figure out where a top
like
is.
that look. Yeah.
Let it fail. So the wedge itself points to 6,000, right? That's
Yeah.
that's your minimum requirement or
Yeah.
expectation on this breakout. You have 161% extension of the last move lower right here at 58 something. That's 127% extension of the bigger move. It comes in at 58 something. The breakout takes us all the way to 6,000. And the only way it's going to turn between now and probably 6,000 is we do get a false breakout. And so again, if it was one of my setups this week on the week ahead video, you get below 56.20 right here, basically this low right here, which was middle of the week last week. It's right there. You get below that, and now you got a problem. If you're bullish, you got a problem. If you're long stocks, you have a problem if we start breaking through those levels. But until you do that, there's no sense in trying to fade it. Now, the one thing I need to point out though is there are a lot of signs that we have in the FX world that could suggest otherwise. You start looking at all the failures in I know you're like, well, the Aussie, it's getting big breakout point. We are at resistance, but we are also at a multi-year trend line. I mean, the fact that this thing hasn't broken out is simply amazing to me, given the fact of the rebound we've seen in copper, the rally that we've seen in risk. How is it the Aussie is still trading down here? I still haven't figured that out. And you have the RBA this week, which could in maybe even be hawkish. I mean, not. I think a lot of people are kind of wishy-washy whether the RBA will continue its Michelle Bullock's fairly hawkish rhetoric, but how about, even with that, even knowing that the RBA might be a central bank that could raise rates in the future versus cut rates, how is it the Aussie's not stronger right now? And these are things that really have my attention. You got the dollar Mexican peso. I mean, this thing, now I know we have new Mexican government coming in a week and change on October 1st, but this should be a lot weaker. But again, it's the pesos, so maybe it's the government, and that probably has more to do with it. But then you got the dollar yen. I mean, how's the dollar yen still trading as heavy as it is? Is there some risk aversion seeping in here where the yen is holding up a little bit better than other currencies? So when you're looking at money or the FX market, it should make anybody who's bullish risk and looking at equities probably a little bit, just keep an eye out. I mean, but then again, you got the DAX, it's trading at near all-time highs too. So I mean, you got equities still don't look broken. There are, I think, some warning signs. But I think I wanted to mention one thing, and Ryan, you'd pointed it out this morning with the euro sterling. You were like, well, 62 cents, 62 or 62, 82. Sorry, it's Monday morning. That's my excuse. 82 pence would be a downside target of the bear flag pattern, which would take us near those lows from March of 2022. So I mean, this is a straight up breakdown, and And those PMIs that we got overnight were not pretty. I mean, what was your read on all that data that came out?
Stinky, still stinky, particularly for Germany. It's been a while since we've seen quite a move in the euro on the back of data like that. And France, the Olympic washout was much bigger than I think anyone predicted or expected. That absolutely fell out of bed. Germany went backwards again, and the details in the German report were less than encouraging. You know, job losses, things like that, and you know, low orders, low optimism, low everything, and yeah, it's not good. It's not good. So
Now,
this is the game we're going to be playing.
is this going to be an opportunity for the U.S. to show exceptionalism again today? What do you think with U.S. data? I mean, you know, you look at expectations of our manufacturing PMIs. They're still expected to be in contractionary levels below 50.
It's possible we could creep up. It's close enough, but if you look at the manufacturing around the globe, there's nowhere that's really outperforming, you know, among the major countries. So it's hard to see that really, you know, shooting into massive expansionary territory in the US, unless you've got some domestic demand that has been hiding somewhere. It's probably a bit too soon for a 50 pip rate cut to start stoking that. Maybe next month we might see it. You know, respondents, if they get excited about a rate cut, it might stir a bit of business. But I don't know if it'll play through in this report. Might be a bit too early.
Yeah, and no, I would agree obviously with that. And we have our services PMIs still, you know, well above expansion. This is the number that I think everybody's got to be paying really close attention to today, because if this number is weaker, that's going to be that's like our, you know, when you have a three-footed stool, that probably is our last stool leg that is still propped up. So we've got a little bit of a balancing act here in the U.S. With the U.S. economy. KMan, I want to ask you really quick as far as Mexico goes, because you can see the U.S. dollar Mexican peso is you know, flirting with you know, I would say 1950. I just got out of mine earlier this morning, and then I rebought it on this dip, but you can see it's kind of looking pretty perky considering everything that's going on. How do you feel the Mexican peso is going to do here with this new government?
Yeah, I'm still on the defensive. I think it's unless something dramatically changes in the US that brings the dollar much lower. This is Mexican peso is still on the defensive, and we were talking about that actually last week with James in our room, and I said like anything below 1920s is perhaps looking good for a fade and a move, gradual move back up. Still nothing that's going to please the investor. So that thing to me is still a buy on deep. So Mexican peso in general, a sell on rallies. I wouldn't personally do it against the euro because I don't like the euro, but yeah, I choose pick a currency that's doing relatively well. And yeah, it is going up in sympathy with the dollar mix, but I'm not a big fan of the euro. But yeah, there's some I think still some decent legs in perhaps a bit weaker mix, and then we'll see if they manage to get their act together on, especially on that judicial thing, because that's where it really hurts investors, or hurts the sentiment of investors towards the Mexican peso right now.
All right, thanks, K-Man. You know, one of the other big central banks is meeting this week, Dale, is going to be the Swiss National Bank. They you know, could really cut rates a little bit aggressively, and one of our traders, Jethro, he's a pilot. That's his old fighter pilot call sign, and Jethro and I have actually met for beers once, and he brought me moonshine from when he was here in Scottsdale. He brought me moonshine from his home state. And he was eagle eye this morning, said, "Hey, Euro Swiss got to the level that you wanted during the week ahead video, and I was looking for a move down to 94.50 to be on the long side." So, Ryan, do you think the Swiss National Bank is going to be able to deliver a more aggressive cut? Because with everything that's happening in obviously the Middle East, my opinion is if you're the Swiss National Bank and you want to make sure that people do not keep parking their money with the Swiss franc, and you're worried about the Swiss gaining strength any further, they're getting all sorts of ruckus from like the luxury good sector in Switzerland.
Those poor people.
Yeah, well, the problem is that with China not spending, yeah, US hasn't really reined in its spending yet, but all those luxury goods that were going to China, I mean, they're like, hey, our prices are with the Swiss franc so strong, it's really killing exports. But anyway, I mean, if the Swiss National Bank wants to make a statement, they could do it this week. What do you think, Ryan?
Well, that must be why China and Switzerland have just started talks to upgrade their free trade agreement, because they're not selling enough handbags. But yeah, the SNB is a bit of a strange one, because inflation never really got as high as everywhere else, rates never got as high as everywhere else, and yet we're still talking about them doing 50 BP cuts. So it's in the balance between a 25 and a 50. Will it stop the market still running to the Swiss for safety? No, never has done. So it's not going to change anything really. But in the interim, yeah, it makes less sense to hold the Swissy when the rates are low in. But then the lower it goes, does it become another funding currency to borrow cheaply over there and put it in your higher yielders? So it's a double-edged sword again, I think.
Yeah. All right. Well, Dale, you think that you have sympathy for the wealthy Chinese out there?
Yeah, if they want, they could buy my raccoon coat that I used to wear to football games.
You got the old Davy Crockett hat. Have you, Dale?
I have a Davy Crockett hat, Brian. So wild on the old frontier.
Oh, started him off.
All right. Well, hey, I'm gonna go. Let's go around the horn really quick. Dale, what are you looking at today of things that you want to trade?
Okay, I still want to sell the dollar at 102 if we get a rally up there. I think you buy this break in euro and cable, and what if and when the dollar does that, euro maybe just a shade under the last low, 109.80, ABC, and then we could probably get a move. So
all right,
I want to buy dollar weakness.
You want to buy dollar weakness? Okay, I'm with you. I'm with you on that. Ryan, what are you thinking today?
Yeah, I'm a little bit on that side as well. Even though I'm against that with my euro dollar long, but yeah, I think the dollar on dips for now is the way forward. Obviously, till the next big bit of data, and then we see what that throws up.
Well, how do you want to play that? Do you want to play it mostly against the euro?
You've gone really quiet, mate. Unless it's just
what's that?
Oh, you went really quiet there.
No, you guys can't hear me?
Now we
can now. Yeah.
Oh, okay. I don't know what it was. Do you want to play that against the euro?
Well, I'm still long euro dollar, and I'm happy to stay in that while we're above 110 and staying above 111 pretty much. But if we get to 112 and it holds, then I might look to go the other way.
Gotcha. Okay, KMan, what are you thinking today?
Well, don't change your winning team on euro sterling and on gold. I'm going to pay very close attention to what's happening on the Aussie, especially with the RBA ahead of us. It's decision time, I think, here. If the RBA stays quite hawkish, despite they should, in theory, start to change tone, but it could open the put up in the way to perhaps closer to 70 on the Aussie dollar, but the other one is Euro Aussie. It's very close to 162.5. If that breaks, I think there's another 1.5% in there.
All right, and guys, I'm gonna, since we're out of time, I'm gonna look to sell euros on rallies today. I think we're forging out a lower high. So I'm with you, Dale. I'm in agreement there. If we can get a move back up towards 111.50, I'm gonna probably be a seller up there because I think it's very manageable risk. I think that the dollar's false breakdown from last week's FOMC is playable, and that's going to take the euro back down towards 110. So I am looking to sell rallies. Guys, I just want to say this: if this is your last week to get ForexAnalytix at the 8-year anniversary pricing lows. So for those of you that have not taken advantage of it, you should, because once these prices are gone, as you all know, they disappear and we don't have them again for a while. So make sure you take advantage of that. Get all these great tools. Jump in the chat room with us. Matter of fact, I was just before we started, I was reading a news article that was posted in there from Benedict. So thank you very much, Benedict, for that. But you get all these great tools, great chat room, news and research room. I can get caught up literally on everything I missed overnight in about 5 minutes, just running through the streams and seeing what everybody else was talking about all while I was sleeping. It's great. And then I have people to chat with all day long. So you should too. Dale, I'm going to pass it over to you. Have a great interview.
I'm waiting. Peter's not quite here yet, so
he isn't.
I just talked to him. Skype.
Oh,
He'll
okay.
here.
So he's coming. He's coming. All right. So
coming.
just to let you guys know, like, here's the chat room. Like, there's some really nice articles being posted in here. There's the DSI, if you guys need to know where that's at. A lot of good articles to get it caught up with. Our trades room, if you want to know exactly where. I scalped in and out of the dollar Mexican peso this morning, and I just picked it up again at 1936. As it's flopping around, and I sold it up at 1950 or 1947 a little bit earlier. So that's, if you want to know how I'm scalping around the markets all day long, you could be in the chat room figuring that out. And remember, our tool has not only currencies, we have bonds, we have gold, we have precious metals, crypto, indices, the DAX, boons. It's not just currencies. So and make sure you download the mobile app so you're notified when all these key levels are being hit. Ryan, any last minute thoughts while Dale's grabbing Peter?
No, just keep an eye on that data a little bit later, the PMI data. See if the US is going to have a little bounce, or whether it's going to stay in the mile like the rest of them.
Yeah. All right. Sounds
He's
good.
Updating that Zoom, the Zoom software.
Anyway, that's always fun.
I want to take a minute. A new season is a new beginning, right? Summer's gone. Kids are back at school. It's time to go to work. We're going to have some historic markets. You've never seen this kind of instability in the U.S., and I've never seen more geo stuff percolating on the oven in my lifetime ever. So we have all kinds of opportunities that are going to present themselves. And you know what the biggest case is? You only have 2 eyes. Okay? And there's only so much you're going to see in your own field of vision. When you're in a community, you see other things because it's not just your 2 eyes, and they're educated eyes. So why not give yourself an edge that most people don't have? Because they don't want to spend 10, 15, 20 pips a month to make more than that. So you look at it as, I call it a good profit risk ratio trade. And try it for 90 days and see if you're not at a 3-to-1 profit risk ratio from being part of this community. And check your email for a code. Let me get him another link.
He's still trying to get Peter over. Hey, real quick, and thanks, Dale.
How was that, Blake? How did I do?
You did good. All right. Yeah, you did good. Hey, it's funny. I've been in a lot of conversations with a lot of professional traders over the last couple of months. One of our ForexAnalytix chat room traders is leading the charge over at the Gelber Group. He's on the top of the leaderboard. I've been talking to those guys quite a bit. These guys are guys that move literally hundreds of millions of dollars every day. And they're in the same camp we are. They're just looking for an edge. They're like, what's your edge? You need an edge in the markets, especially when you're trading against many institutions and professionals that have a ton more money than yourself. So you got to be looking for an edge, and that's what we provide for our traders, is having multiple eyes around the markets at all times. Dale, are you in? No, still.
He's having trouble with Zoom. He can't get Zoom to work.
Oh my gosh.
Yeah.
Blake?
So
Yo.
So there's just a question from Surab, if I get the name right. Can he sign up for a bet for 5 years? What's the best way to contact us to do that? Is it via the chat on the website?
Contact us through support, and we'll figure out how to do that. We've never done it.
If you go on the ForexAnalytix.com website, Surab, you'll see an intercom button where you can chat with our support team. Just send them that request, and we'll see what we can do for you.
Are you sure we would take someone for that long? I'm kidding.
Yeah, man. I went wakeboarding yesterday, and at 52 years old, after being pulled around the back of a boat on wakeboards, I'm like, can I make it 5 years?
Where were you? Lake Pleasant?
No, we were at Bartlett Lake yesterday.
Right.
Water was beautiful, by the way. It was 82 degrees. It was gorgeous.
I liked that shot of you skiing on one ski and holding your wife up in the air.
Yes,
that was an amazing thing. That was great. Anyway, Peter made it. He got through the Zoom gloom.
Did you promote him?
He's here.
Oh, is he on the panelist?
Yeah. Oh,
no, not yet.
Okay, you're going to be promoted, Peter.
All right, guys, good luck this week. Make sure you're here every day. We got a lot of data coming out throughout the week. We'll be covering it live. So make sure you're here with us on the F.A.C.E show. For those of you that are ForexAnalytix subscribers, remember, I'll see you in 40 minutes from now on the Morning Edge. It is for only ForexAnalytix subscribers. We make the bias chart every single day, and you can see it right here. We do it together. So Dale, I'll sign off now, and have a great interview with Peter.
Okay, thank you, man.
Thanks, guys.
All right, Peter Goodburn.
Yes, I'm here.
All right, my buddy. By trading more your brother, it's great to have you back.
Yeah, apologies for the slight delay.
It's live TV. We can be flexible. Okay, so Peter, I want to start off by acknowledging the great call you made on yields. You were negative yields when it wasn't fashionable at 4.5%. People are even talking about, well, maybe the Fed needs to hike again in that period. And back then, you had a count that would take us down to 3%. It seemed very aggressive. Now it seems realistic. Great work, Peter.
Thanks, Dale. Yeah, I'm actually sort of looking at the 2-year yields over the weekend, and they're getting very close to reaching their numbers. So I'm just scratching my head a little bit, thinking, wow, the 2-year is getting to sort of some interesting fib numbers. Let's put up the 2-year.
Yeah.
And I'm just thinking, well, how can that be? At this point in time when the Fed are just cutting rates and everybody's expecting sort of further rate cuts. But it looks a bit like this. These are the downside targets that we had at 3.4%.
Okay,
and
that's not sharing yet.
I'm not. Oh, sorry. Let me just.
So you hit the share. It's the bottom button. Share screen.
Here we go.
Yep.
I think this is going to be the right one.
Yeah, there you go.
Can you see the 2-year yield?
Yeah, got it.
Okay, sorry about that. Yeah. Yeah, this is the 2-year. What we've just been talking about is the 10-year, this one.
Right.
Going down to 3%. And of course, this has still got some way to go. This target, by the way, for everybody tuning in was just derived by extending primary wave A down to 378. So that's the October-April drop,
Right.
October-December drop by 61.8%. So that's a sort of a standard measurement that we'd use for a C wave decline. And we applied the same measurement to the 2-year yield. So we've taken this same decline down to 4%, 412, extended that by 61.8. That derived 340. And as you can see, we're within touching points now. We've only got 20 basis points ready to go. And that's a very interesting scenario.
I would argue for another inversion right when the market was starting to come out of inversion. That there's more upside in the further out you go, because there's still capital gains, where the short end of the market is almost there.
Yeah, I mean, I've also just had a quick look at our 210 analysis on the spreads, and have a look at this. Here's the 210s. We had a target some time ago going up to about. It's exceeded it slightly, but the wave pattern is still secure. It's 5 waves up from the inversion low of -111 here.
Right.
1, 2, 3. Nice triangle wave 4, 5.
So we go negative one more time.
Yeah, it looks like negative one more time.
Okay. All right.
And a pull back to, wave 4 preceding, which is normal. That we bring us back down to -50 basis points again. So, that's quite interesting. And I mean, just at the point where everybody's starting to think in terms of, continued rate cuts and what that means. I mean, this either suggests that the market's already pricing in enough for the moment. And, some of the data might come through in the next weeks, which is a little bit
sticky on inflation.
Yes.
Or, how about that?
Yeah, a little bit sticky.
Okay.
And they might then like defend, stay put until the end of the year. And we start pricing in, we start pricing out, I'd say, a little bit of what we've been pricing in.
Okay. Because, I mean, the question I have to my mind, I think we could go to the 10-year 3%, but what that's implying is that our next move is into new high ground. What could be, and I'm trying to think what could drive that. And I don't think it's going to be strong economic growth. It's just going to be supply. So could we have a weak economy and on top of it, a weak bond market because we have a weak currency and money flow is out of US dollar denominated assets?
Yeah, well, we've certainly got sort of the dollar index sort of in a downtrend. I mean, this is the current analysis.
Yeah, you've been pretty accurate on the dollar too, Peter. You've been there for most of the turn. So nice work on currencies. And,
yeah, thanks. I mean,
and the metals.
Yeah, I think the pattern on the dollar index has worked really well because we've seen going back to this October 2022 high, we saw a nice 5-wave drop, a nice expanding flat for wave 2, a new impulse decline, which began actually intermediate wave 1 in the larger context. So this is minor wave 1 of 1, and the second wave was, as you can see here, nice 3-wave recovery up to 106.51. That was April, I think. And then we're gradually working our way down now. I mean, it's not getting quite as aggressive as this decline. Yeah, it's quite orderly. Yeah,
and choppy.
And choppy too. Yeah, it's. I mean, we've got lower lows, lower highs, so that's the definition of a downtrend. From an Elliott wave perspective, the downtrend is obviously a bit more detailed because we're looking at 5-wave impulse declines and successive degrees of trend downwards, which is basically being adhered to. So overall, the implication here is very much dollar declines. I think my line of thinking.
Trump wants a lower dollar. Okay, they're already talking the dollar down. Now, so I've been with you on the dollar. Does that make you nervous, Peter? Or, now there's more company than there was at 106, 107. And how does an administration get a lower dollar if they want a lower dollar?
Doesn't seem as if they need to do much at all, really, from the pattern sequence itself. I mean, the only thing is, of course, the mindset of the market is very different to what the Fed is orchestrating. I mean, basically, if we go pre-financial crisis, we had a Federal Reserve which was very much playing the game of Paul Volcker in previous eras, where the Fed kept its cards very close to its chest and didn't reveal much. Ever since quantitative easing was produced, they're now telegraphing ahead of time what their intentions are. So they've become very much more transparent than they've ever been in the case of history. And more recent years, since pandemic, they seem to be basically following the data like each of us.
Well, I mean,
they're
I
not very
think the Fed,
preemptive at all.
didn't the Fed follow the market? The 10-year was, was saying they were going to cut. They were way behind where the market was. So who really leads? People think the Fed lead. They made a big deal out of cutting a half, but like you showed on the yield chart in the last year, we've gone from 470 to 320.
Yeah, I mean that's the case. The Fed are not really being preemptive at all.
No.
They're being very reactive, which is the worst. As you know, being reactive is one of the worst things you can be doing if you're trading.
Exactly.
You've got to be preemptive. You've got to anticipate. You've got to forecast changes ahead of time. And it's no good responding late into the session. And in a way, what the Fed have done by hurrying through a 50 basis point rate cut, it's almost as if they've gone into panic mode, like buying the top of a market or selling at the bottom, exactly what the opposite you should be doing. Okay. And that's also triggering my sort of contrarian situation, especially when we are coming to sensitive 61.8 extension numbers on the 2-year Treasury yields. So the Fed are really doing it all wrong, really. I mean, they're not giving the market any surprise action, and the market's actually eating what they've produced, because the market's mindset is very much tuned into what the Fed are saying, and yet the Fed are reactive, so it makes the market reactive. So if you cast your mind back to December last year, when we had sort of yields very much higher leading up into this period, the yields were actually dropping down, and everybody said, yeah, the yields would continue to drop. I think the Bank of America sort of surveys were saying there was
before they turned,
like an 80% probability that yields would just keep dropping. And that was the highest on record in the survey, which suggested, of course, from a contrarian point of view, that yields would actually go up, which they did. They went all the way up here, from 4% to 5%. So
had to blow them out, blow their credibility out first.
Yeah, well, I think we already know that. I think
banks are good to fade. Some of them, yeah.
Yes, I think there's something. Which will happen probably in October in the stock market, which might give us a bit more clarity over the interest rate scenario. Because
so you don't think they could hold it together for your B wave until after the election?
It does seem that way, because I think there might be an intervening. When is the election? November when? November 3rd or something?
I'm not sure.
Yeah, I think we have to check that, but I think it's something like that. But I think that we're going to get an October high here on the S&P, and most of the other contracts like the NASDAQ and the Eurostoxx 50 that we're tracking here in Europe. I think we get that sort of B wave nudge to the higher highs, and then we get a drop. That's about an 18% decline. I think the on the NASDAQ,
a lot of people will turn bearish, taking out the April low, July low.
Yeah, that early August low. Yeah.
Yeah, before that they'll turn negative, but they'll get pretty negative there. Okay.
Well, at the moment, of course, the mindset is lower rates and continuing, and so on and so on. And so there's a bullet. I mean, I think practically every investment bank between last Thursday, after the follow-up of the Fed cutting rates, and now have come up with revised targets for the S&P much higher. Some have said, Goldman Sachs, I think, have said, well, after a rate cut like this, if there's no recession is the big if. We're going to see, history says that there's going to be a 17 to 20% increase in the S&P 500. And Deutsche Bank last week said over a 2-year period, if there's no recession, again, There's that sort of provision. Then the S&P will rally 50% into the end of 2026. That's going to go even above some of the big long-term upside targets that we have.
So you always had, wave a pullback, like, before you were looking for about 3,000. Okay. But you always had that new high of 7,400 coming into the S&Ps. Okay. I remember those numbers better. The only difference is when you saw what happened after the July peak, and I believe you thought it was only 3 down, that your idea of a pullback into the fall, that narrative had to change. You saw something that changed it, and you did, and you didn't fight the market going to new highs, and you had these numbers up there. But let me ask you this as a trader, Peter. When you have a narrative that you have conviction about and you stay with it, and then you have the authenticity to say you're wrong, there's a different count happening. What mental process do you go through to be able to make a turn in a count, even though it's really the same count? The only difference is from where it started and the levels. Do you think about opportunity costs because your count, you were looking at the other side of the market, rather than being long with the market? What do you go through as, I know you have institutional clients, you have a lot of people that depend on your work, and you depend on your work. You trade your work. So
yes.
What do you go through, your process as a trader, when you have to shift a wave count that perhaps you've believed in the narrative of that count for many months and then have to turn?
Well, the narrative change and the mental process is quite significant, actually. It's not something we take very lightly, because we do a lot of cross-correlation analysis in order to come up with a theme anyway. When we started looking at the way in which the 2022 decline occurred, we had a lot of inconsistency and overlaps in those declines. And more so, when we take a look at, say, for example, the pandemic advance in the S&P and NASDAQ, and also we've got some very good ratio relationships in the Dow Jones futures from the pandemic low. They all showed a consistent 3 price swing event up ending into the it was either November 21 for the NASDAQ or Jan 22 for the S&P, Dow, and things like that. Also for shares like Microsoft and 1 or 2 others. And this gave us a bit of a tip-off at the time that the advance for intermediate wave 5 from the pandemic low wasn't going to take a conventional 5-wave expanding impulse pattern. For those tuning in with Elliott wave knowledge, a typical 5-wave expanding impulse pattern would look something like the one on the top left-hand corner here. This one. I think many of you might be familiar with that pattern. You see typically a 3rd wave expansion in the 3rd wave. So it gives it this generic sort of 5-wave impulse. But that's only according to the fact that, the initial swing up from the pandemic low was a 5-wave pattern itself. Well, we only saw 3 waves, and we kept on seeing that repeated over and over again. So we started to adopt the diagonal process, this one, and that required a very deep correction. And so we analyzed the authenticity of that deep correction, and we came up with inconsistencies in the decline into the October 22 lows, and said, well, we think that there's going to have to be a much deeper correction, because we were only 38% correcting in that phase. That's pretty small.
Yeah.
As it's turned out, we've gone through the process and we've adopted this one, which is the expanding diagonal. And the expanding diagonal doesn't require such a deep 2nd wave correction. But the only reason for that is because when we started to look at the analytical process, we knew that July, if it was going to collapse lower, that would have had to have withheld or withstood the time. And the reason being, there were 2 significant ratios which pinpointed that top. One was basically extending this original zigzag by 61.8. So I'm going to do that now, just to show everybody how that works. So there's there's that extension line coming in. And the other one is to extend, we take the inverse of the golden ratio, the 1618, and we extend wave A of this expanding flat like this. And you'll see there's a second line overlapping it. And we've hit that pretty much consistently with so many other indices into that July high. Well, when we saw 3 waves down, we went through the whole process. I mean, it's fairly automatic. So we say, right, okay, 3 waves down. Is that a correction, or is it a bearish 1-2-1 pattern? And as soon as we broke above this secondary high in July,
that's when you changed.
That's when we had to change. We said, no, look, if this is going high, now we're forced to make the change. So it's fairly automatic, really. We've just gone through a process, a fairly rigid process. And so we haven't taken it lightly, and we haven't done it arbitrarily either. I mean, it's gone through various different gates and processes for us to then say, right, okay, we're going to have to adopt the expanding diagonal now, which rather looks like this. But the next question that we asked ourselves was that, okay, if we're adopting the expanding diagonal, and this is wave 3, these are the sort of minimum targets that we could expect for next year. Where are we in that process, which is this process? Now, we know that wave 3 of an expanding diagonal, it must unfold into either zigzags or double zigzags or triples. So these are the only 3 things that it can work into. It can't do anything else. So we have to work ourselves into some fib price ratio targets, and this one fits better as a double zigzag. But then the next problem arises. Some of the major indices and equities have dropped down from their July highs into 5-wave patterns.
Yeah.
And this is Alphabet Google.
NVIDIA? What's that, NVIDIA?
No, this one is Alphabet Google.
Okay, Google, yeah. And you were calling for 140 a long time ago. Almost got there.
Yeah, it got down to here, but I think it probably will get down to sort of something like 131 and return back to wave 4 preceding. In this case, I think it could get down to 125. And the reason for that is because it has dropped in 5 waves.
Yeah.
So if you think about the dates when the stock market topped out in July, we've had the NASDAQ drop down in 3 waves. The S&P dropped down in 3. They're making new highs. Well, actually, the S&P, not the NASDAQ at the moment. But we've seen some equities within the mega caps, the mag 7s.
Yeah, yeah.
They've dropped down in 5 ways. So how do we reconcile that? According to, now a minor 3rd wave, which is going up next year to new highs. Well, if you take a look at NVIDIA, which is the next chart, you'll see that the correction down from this high at 140.76, we've labeled it as the same, actually as an expanding flat. A down, B that makes a new record high, and C down. So on the one hand, you've got equities like Alphabet, Google, which we consider to be underperforming.
Put in failing rallies. Some are even within the Mag 7.
Yeah.
There's bifurcation.
Mm-hmm.
Even within the 7. Okay.
There's price.
That's a tough environment,
Yeah, there's price synchronicity. So in other words, you go up and down at the same pace, but the amplitudes are different and they create the different patterns. So we see this a lot. So when we make comparisons with different stock indices across different global indices, or we might even look at currency crosses or pairs and make the same distinction, you'll often find that when corrections unfold, there will be outperformers and underperformers. The underperformers will decline into zigzags so that the B waves never make new highs in that pattern sequence. But the outperformers will make higher highs as B waves, like NVIDIA will make a higher high because they're outperforming. But they're still basically corrections, you see, and they're synchronized price-wise the same. They go up and down the same vibration, but the amplitudes are different, which creates the different patterns.
So tell me what you think. Here's my style, looking at those 2 charts. I think that would be a tasty short up there, but my preferred short would be Google, because it's going to make a lower high. It had 5 down. I'd rather sell relative weakness than try and be a hero selling the relative strength. I'll buy the relative strength, but I'd rather sell the weak sister.
Yeah, exactly. Yeah.
All right.
Yeah,
so
no, absolutely.
That's probably a higher probability short because it's already showed its hand, right? And you
Well,
also
what
have
we
you also have a stop loss point that's
yeah.
very reasonable on Nvidia. You could sell it at 65, and sometimes, you know, Peter, the rubber band stretches further than we think and takes longer than we think for it to happen.
Well, up here, you've got no stop loss unless you wait for the
Yeah,
reversal signature to go downwards, and then you have to put a
that,
stop wherever the high is.
right,
But of course,
right.
here, yeah, you have got a stop loss above 193. You know,
Yeah,
risk reward wise, that's pretty good. You know, if you were to sell there. But what I would do to play that, and for anybody tuning in today, I never play these numbers. I mean, we calculate the numbers, and this is where we expect potential reversals, but we never play the numbers themselves. We
yeah,
wait for a reversal signature from the numbers to validate. And then when we go short, for example, if you want to go short this equity or something on the equivalent to, you know, the indices, then you wait for the reversal signature and then you put a stop above wherever the high
yeah.
is. But what
That's
you
it.
should, what's going to gain confidence in this forecast is if you get close to these numbers here, we don't break the highs. This does a secondary high, remains below the high. Meanwhile, this one breaks into a higher high somewhere.
You have some
And
euphoria up there.
and then you see a synchronized drop where both give reversal signatures, then you know what's going on. And you have a pretty good idea what to aim for as well. Because trading is not just simply about executing an entry order in something.
It's about
Because
managing the trade.
yeah, because your survival in trading longer term will depend on your risk reward setups.
Yeah,
You know, it's simple as that. So you've got to know where your exit point is, or an attainable target that's realistic. That's I have to say it
yes.
is realistic, because
There's a
going,
pro.
you know,
Write
you
these words down, everybody. That's an order. Peter, could we wrap it with gold?
yes, we can. Um, I think we're probably getting close to a top here.
Yeah,
It looks a little bit stretched. We've got a 5-wave advance from 1810, and we're in the 5th wave. Now, I don't think we've got a subdivision of 5 waves from the last correction here at this period here from 2431. Now, it's either a running flat down here for wave 4 to 2287, or it finished a conventional small correction there at 2278. Either way, we can't count 5 waves up. So we know that minor wave 5 from 2278 hasn't finished. At best,
yeah,
we're in a 3rd wave. And there's
right.
been a 3-wave, a denoted 3-wave advance so far in here. So we think that this is probably characteristic of a zigzag within an ending diagonal. And if that's the case, we'll get a 4th wave down to 2400 or thereabouts, and then we'll get a
Wow.
5th wave up later.
Yeah, with the market.
Yeah.
So it's going to pull back with the market for a little bit here. That's a big break, though. That's going to break some trend lines for people.
Well, we've got
2400.
silver also doing a zigzag upswing from this
Yeah,
August low. And you can measure the quality ratio in a zigzag here, ABC. We hit it on Friday. It's come down a bit today. So
yeah,
I'm
yeah.
doing a little bit of a short position on that at the moment. But
Okay.
basically, if you look at the gold silver ratio and work out the numbers, you'll get an idea that gold should drop down to 2400 thereabouts, and then
Okay.
we can go from there. Yeah.
You know what, Peter? I talk about that it's all one market because for the most part, stocks, metals, the dollar, you get the dollar right, you usually get everything else right. It's all one market. They just go up and down with different magnitude. So it looks like, based upon what I've seen today, that when you have silver at 33.90 and gold after this pullback making a new high, and possibly the S&P up there at the same time, that
Yes.
just like the whole board has been along with dollar weakness, that the
Right.
whole market's going to take a pretty good breather.
That's correct. Yeah. So look at these. You're exactly right, Dale. I mean, look at these correlations, because I know it's a lot of work. I mean, we're doing a lot of the work for you. So you can basically, but you still need to do your own work. You know, take
Yeah,
my
you
my
do.
key to trading is take always self-responsibility. You know,
Yeah,
self-responsibility. You do it in your own life. You do it in trading too. And that means you've got to do a little bit of legwork and look at cross correlations. Maybe, you know, if you're a specialist in some different currencies and you can see the correlations going on, and if you're a currency trader, that works that way too, in commodities also. But you can also apply it into the bonds or the stock markets, and just look at the more things you look at. Doesn't mean to say that you have to trade them all.
Right.
But the more things you tend to look at, and if you look at them in a specific way, you'll see these correlations, and it's very, very useful. I think actually it makes us all a better trader if we do that type of correlation work.
So are you saying, Peter, if you hear someone or me, like right now, say, man, that yen burned me, that I'm not taking responsibility
Yeah,
for being wrong? Huh?
Yeah, you're not taking responsibility if it's because it's not.
I got burned by the. I'll never trade that yen again. It burned me.
Yeah, well,
I had to get one of those laughs out of you today. Anyway, Peter, your stuff, you know, I rely on it. I love it, and I think people should get it.
Thanks a lot.
So,
thanks for the plug.
So anyway, so why don't you show people how they could do it?
Thanks. Yeah, just briefly, this is the Elliott Wave Compass report. We publish twice a week. It's, I think, $39 a month. And so this is what it looks like when you download it. So you get all the charts and some running commentary. If you log in online, you'll see it a bit like, here's my attempts to get Zoom working. You'll see it a bit like this. Here we go. Elliott Wave Compass. And you can just go to the report and you can see it, all the charts online. You can either select them individually or see them as a grouping. But basically, if you scroll through, you can log in. You'll get access to this 24/7, of course. And you can download the reports from here. So that's one way of doing it. If you do go online, go into registration and subscription. Here's the subscription area, and you can see the Elliott Wave Compass report, and here it is, $39. So that's a good way really to follow what we're doing. And occasionally we are posting some interesting stuff on Twitter, not quite as often as many people would like. We're very busy in the office doing all of the other work, so the main thing is really to subscribe to the Compass report. But if you are doing it and you've got questions, once you become a subscriber, and if you've got questions, ping us messages, because we're getting lots every day from the Compass community, and we're quite happy to answer your questions. Only so pleased to do that. Yeah.
Okay, Peter. I want to thank you. What do you think about the far right gaining some political strength in Germany?
Reading all about it in the Financial Times today.
All right. You live there and you rely on a UK paper to tell you about it?
Yeah.
That's good.
It's a sad fact. But I do go to the market sometimes. I had a very interesting conversation with two lovely women from Hanover, and in a cafe last week, and we did talk about it actually, but I'm not going to talk about it on air.
All right. Okay, it's like that everywhere now, Peter. It's such a toxic environment everywhere, and I'll say that on air.
Yeah, well,
toxic.
That brings us to a very, very significant opening. I hate politics, to be honest, because
me too.
I just politics.
Be glad you're not in the U.S., man.
The flip side, well, I can see what's going on there, but the flip side to politics is religion. I'm not religious, but I am spiritual. And the two go hand in hand as far as I'm concerned. I don't like politics and I don't like religions because they are more separatist than unifying. But that's another story for another time. Maybe we'll do a separate thing on those subjects.
All right, we don't offend people talking about the religion of money.
No,
and the worship of profits and the reaping like out in the fields of wheat, reaping in all their profits and putting it in their silo so they have enough for themselves the rest of their life.
Yeah,
right?
I know. There is that part to it too. Yeah,
there's that temple. There's
I
that
know.
temple, man.
There is that. There
Of
is.
mammon. Anyway,
Yeah.
look, I have to get busy and make some money here, man. Anyway,
Yeah, let's
Peter,
get going. Let's get
you
going.
could
Come
tell
on.
you could tell I missed you. Great to hang
No,
out with you.
I miss you too. I miss you too. We haven't spoke for a while, so
Yeah.
yeah, we've got to have a longer chat. So, look, everybody tuning in today, thanks. It's really great to be able to show you everything going on here. And there's, we could talk for hours about stuff. But time limits, and we need to trade. So, good luck with everybody. Thanks for the invitation today again, Dale, and we hope to hopefully catch up soon again.
All right, my trading warrior brother, Peter Goodburn. Find him at ElliotWave_WTI on X and go to his website. Okay. Have a great day, everyone. Don't just count your wave structures, count your blessings. See you later. I made Peter laugh a few times. That was my goal today. I feel rich. Adios, everyone.
Thanks. Bye, Dale.
See you.